Central Jersey, all about bank loans. And we're going to talk this morning about some tips on how to prepare for and then get a bank loan. And this is we have a banker with us today, so he knows all the tips and hints about how to do that. Hassan Pride is an experienced banker. He is currently vice president of commercial banking at Valley Bank. And Hassan is also a SCORE mentor, an excellent SCORE mentor, I might add, and has been in our Central Jersey chapter for, I don't know, 4 or 5 years, maybe, for quite a while. He does a lot for our chapter as well as for our clients, so we appreciate him. And Hassan, thank you for presenting this information for us today.
Thank you, Jane. Thanks, Jane. Thanks for that wonderful introduction. And let me see if I can share my slides here. Can everyone see?
Yep, we have it.
Great, great. So thanks again, Jane, and thanks for inviting me to share my thoughts on this topic. As Jane mentioned, my name is Hassan Pride, and I've been a SCORE volunteer since 2018. I've been in banking for a little over 20 years, where I've spent most of my career in commercial lending. Now, most of my commercial lending experience ranges from underwriting small business loans through the SBA program, through underwriting participations for syndicated transactions in the hundreds of millions of dollars, and everything in between. Currently, I'm a relationship manager at Valley National Bank, where I manage a portfolio of middle market commercial clients. Now, generally speaking, that means these are companies with revenues of the tens of millions of dollars. So my goal today is to provide you as small business owners and entrepreneurs with an understanding of what bankers are looking for when considering your commercial loan request. By the end of this presentation, you should be familiar with the most common loan products and their typical uses. You should also be familiar with the initial financial documentation that just about every applicant needs to provide to a bank when seeking a commercial loan. Another takeaway should be an understanding of the key questions bankers attempt to answer when considering a loan request. Now, before I begin, I have a disclaimer. Banks come in a variety of sizes and have a variety of resources available to them. When I last checked, there were 107 different banks and credit unions that do business in New Jersey. Now, I'm not talking about 107 different branches. I'm talking about 107 separate financial institutions that have a presence in New Jersey. Now, among these institutions are places where a $600,000 loan is a significant loan amount and requires approval from the top of the house. Then there are other institutions where spending time on loan requests under $1 million is considered a waste of time. I say this to point out that it is virtually impossible to have complete uniformity among these institutions in their lending processes and decision-making. So the ideas that I present to you today are general in nature. So for instance, I suspect that there are some entrepreneurs on this website that are probably seeking relatively small amounts, which can be approved at some institutions solely based on a credit scoring methodology. If those borrowers have a good business credit score from one of the 3 major business credit bureaus, done in Bradstreet, Experian, or Equifax, they may find a bank that can approve their loan with minimal due diligence required. But what we're discussing today reflects how a typical loan is underwritten by an underwriter at a commercial bank. In other words, when it is underwritten by an actual person, not just approved by credit scoring. So let's first begin by discussing a few of the most common types of loans small business owners seek from a bank: term loans, commercial mortgages, and lines of credit. To be sure, there are several other subcategories, but in today's webinar, we're just going to cover the fundamentals. The idea is to cover the general attributes that these type of loans have so that you approach a bank and have an idea of the type of loan that's going to meet your needs. So let's discuss term loans. A term loan is one of the most fundamental credit facilities. If you've ever taken out a loan to purchase a car or had to make monthly payments on that loan, then you're familiar with a term loan. A term loan is a loan from a bank for a specific amount that has a specified repayment schedule. Business owners typically use term loans to purchase assets like computers or equipment, or to consolidate and refinance existing debt. Term loans can be short-term, say just a couple of years, or long-term. So here are some things to keep in mind when considering obtaining a term loan from a bank. One, if you're using a loan to purchase a business asset, the bank is usually going to use that business asset that you're purchasing or refinancing as the collateral for that loan. For instance, if you're a manufacturer and you're purchasing the latest extruding machine, then that extruding machine is going to serve as the collateral for your loan. But let's say that in the past, you used credit cards to purchase your equipment, and now you're looking to refinance that high interest credit card debt with a term loan. Then the bank is going to take a lien on all of your business assets. That entails the bank of filing of what is known as a UCC lien on all of your company's assets. In general, this will exclude real estate though. So in the first instance, because you're buying an extruding machine, you can have an arrangement with the bank where the lien is only on that single piece of equipment that you're purchasing. In the second instance, when you're refinancing general debt, the bank is going to place a blanket lien on all of your business assets, not just a specific piece of equipment. Another thing to consider about a term loan is just that, the term of the loan. In other words, how long of a maturity that loan will have. It is typical that if the loan proceeds are used to finance the purchase of an asset, the term loan will not be greater than the useful life of that asset. So in the case of an extruding machine, let's say that we imagine the useful life of an extruding machine is 10 years, and I'm just making that up. Then the bank will not provide a term loan to purchase that machine that's longer than 10 years. And the likelihood is that it's going to be even shorter, say 7 or 8 years, which is shorter than the useful life of that asset. Another component to consider in a term loan is the interest rate. Now, most people think that the interest rate on a term loan is always fixed and that your monthly payments on that loan will remain the same throughout the term loan. While fixed rate terms are the most widely offered term products, just be aware that this is not always the case, as the interest rate on term loans can also be variable, meaning that interest rate and therefore your periodic payment amount could fluctuate depending on the index that rate is tied to. Now let's talk about commercial mortgages, which are another common type of loan that small business owners look to secure. Essentially, a commercial mortgage is a term loan, but specifically, it is a term loan secured by a mortgage on commercial real estate. So the typical uses for a commercial mortgage are to purchase real estate, to refinance debt, or in the case where the business owner already owns that real estate free and clear, they can take cash equity out and use that cash for expansion of the business or some other projects. Now let's discuss the characteristics of a commercial mortgage that differentiates it from a typical term loan. First, as we already mentioned, the loan is secured by filing a mortgage on real estate. Recall that a run-of-the-mill term loan is secured by filing a lien on business assets other than real estate. Secondly, even though a commercial mortgage can have a term of 5 or 10 years, because the useful life of commercial real estate is longer, the amortization is longer than a typical term loan. So what is amortization and how does that relate to the term or maturity of the loan? Think of amortization as the length of time that it will take to pay the loan down to zero. Let's consider a 30-year mortgage on a house, for example. If you make 360 consecutive payments on that mortgage on time, at the end of 30 years, you will have paid off that entire mortgage. That's because the amortization is the same as the term. Banks, however, do not provide commercial mortgages with significantly long maturities like 25 or 30 years. It is common to receive a commercial mortgage for 5 or 10 years with a 25-year amortization. That means the payments will be calculated as if your loan will be paid down to zero at the end of 25 years. However, that loan will mature at the end of 5 or 10 years. So there will be what we refer to as a balloon payment due at the end of the 5 or 10-year period when the remaining balance of that commercial mortgage is due. So you may wonder, what happens at the end of that 5 or 10-year period when my loan matures? Well, the borrower would typically just go and refinance that balance with another commercial mortgage. And that could be at your same bank, or you can look at a different bank to refinance that mortgage. One other thing that borrowers need to be prepared for are the higher costs that are associated with commercial mortgages relative to obtaining term loans. The borrower should be prepared to pay an appraisal fee for an appraiser that the bank will order to verify the value of that property. This will be in addition to any appraisal that the borrower may have gotten on their own. Another typical expense that borrowers aren't aware of is a phase one environmental report. This will be ordered by the bank if the potential exists that there may be contamination on the site. And sometimes banks, actually most of the times, banks, whether there's a potential that's known or not known, they're going to order a phase one anyway. So if you're purchasing a building that is adjacent to a gas station, it is very likely that the bank is going to order a phase one report on your property just to make sure that there's no contamination. Also, as in the case with other commercial loans, in addition to the borrower paying for his or her own attorney to review the closing documents associated with that bank loan, the borrower is also going to be responsible for paying the bank's legal costs to providing that loan. So as you speak to your lender regarding a loan, you want to find out exactly what expenses you should expect in connection with your loan. Now we'll discuss lines of credits and some of the uses. A line of credit is a loan facility that a bank provides to a borrower to give that borrower access to a maximum level of cash within a stated period of time. The term line of credit is a pretty broad term because there are so many variations to what the structure of a line of credit could look like. For instance, a line of credit could refer to a working capital line of credit. A working capital line of credit is a line of credit that businesses use to cover the business's operating expenses. Most borrowers tend to think of working capital lines of credits when they're considering a line of credit from a bank, because the structure is similar to a credit card, as the funds from a working capital line of credit need only be advanced when a business owner needs the funds. Typically, a line of credit is made available for between 1 to 3 years. So a business owner can borrow from and repay the loans on a line of credit as long as that line of credit is available, and as long as they're in compliance with whatever their loan agreement states. So for example, if a borrower gets a $500,000 one-year line of credit from a bank, the borrower can close on that loan on day one, but does not have to advance any of the funds until they actually need it. And they have access to that entire $500,000 for the entire year. So if the borrower advances any of that $500,000, they only owe interest on the amount that was advanced. And as they repay the principal back, that principal amount once again becomes available to the borrower to reborrow over the term of the loan. The idea behind a working capital line of credit is that it provides the borrower with liquidity at times when their operations do not generate sufficient cash on their own to support the company's expenses. As an example, a typical use occurs when your business sells to other businesses, otherwise known as a B2B transaction, and your business customers are not required to pay for, say, 30 or 60 days. Well, you pay your employees every 2 weeks, so you cannot afford to wait till you get cash from your customers in 60 days. So you borrow from your line of credit to pay your employees, and when you get the cash back from your customers, you repay the principal back down that line of credit, and then it once again becomes available to you to borrow the next time you need it. Another common use for lines of credit is to support other financial tools like surety bonds and letters of credit. Suppose, for instance, that you're a contractor who bids on municipal projects. Well, many municipal projects require that the general contractor be bonded by an insurance company to ensure that project is completed. So in order for you to get a surety bond from an insurance company, that insurance company is going to determine the bond size based upon how liquid your company is. So if you have an unused line of credit from a bank, that potentially increases the size of your bond that you can get, which in turn increases the size of projects that you can then bid on. Similar to credit cards, a line of credit can be unsecured, or similar to a term loan, lines of credit can be secured by collateral. If it's a secured line of credit, it will typically be secured by liens on the company's business assets, again, with the exception of real estate. In fact, there are working capital lines of credit known as asset-based loans that are tied to particular working capital assets like accounts receivable and inventory, which leaves other assets like equipment available to be used to secure other loans. Lastly, I want to talk about another fairly common type of line of credit, an equipment line of credit. An equipment line of credit is a form of a non-revolving line of credit. Equipment lines of credit are designed to assist business owners who have large capital expenditure requirements, purchase equipment they need for their business as they need it. We previously discussed how a term loan allows you to purchase equipment, but with a term loan, the funds are distributed in full on day one that you close that loan. With an equipment line of credit, you can close on a loan, but you don't have to advance any of that money until you actually need the funds to purchase equipment, which could happen anytime between the day you close on the line of credit until the day that the line of credit matures. So for example, let's say that you anticipate needing a large piece of equipment that costs $100,000, specifically for a project that you'll start in October. You can obtain a 1-year, $500,000 equipment line of credit from your bank now, but you do not have to take an advance on that line of credit now. Thus, that entire $500,000 is available to you because you're not accruing any interest on it because none of the monies have been advanced to you yet. Instead, you can wait until September, for example, to send notice to your bank to disperse $100,000 to pay that invoice for that piece of equipment and have it delivered just in time to start your project. Now that's a way to save cash, right? So now you have $100,000 outstanding on your line of credit and $400,000 remaining available to purchase additional equipment when you need it. So this $100,000 that you have outstanding can be treated in one of two ways depending on the option that your bank offers. For one, that $100,000 advance can immediately become a term loan that becomes repayable in monthly interest and principal payment for say 5 years, for example. In this case, the $100,000 is treated no different than if you actually received a $100,000 term loan from your bank in September that will now be repaid in full 5 years from the date that you advanced it. The drawback to this type of option is that it creates multiple term loans that you have to keep up with each time you take an advance on the line of credit. The other option is that your bank allows you to only pay interest on any advances taken on the equipment line of credit until that equipment line of credit expires, at which point the entire outstanding balance turns into a term loan for say 3, 5, or 7 years. Under this method, it creates a single term loan at the end of 1 year. So there we have it, folks. Term loans, commercial mortgages, and lines of credits. These are the most common loan facilities, and the lending needs of most small business owners can generally be addressed by one of these three facilities. So next, we're going to discuss the information that borrowers typically need when they're requesting a commercial loan from a bank. A fundamental component of any loan request is the loan package. Generally, when a borrower is looking for a loan, these are going to be the documents required in the loan package. Now, it's not exhaustive, but most of the items here are generally required for any commercial loan request, regardless of the loan size. The banker is going to request 3 and at minimum 2 years of the most recent business financial statements. They're going to request 3 and at minimum 2 years of the most recent personal tax returns for each person that owns 20% or more of the business. They're also going to want to request a completed personal financial statement for each person that owns 20% or more of the business. Now, similar to a balance sheet in a business financial statement, the personal financial statement lists the individual's assets, liabilities, and their net worth. And generally, you can get this document from the bank that you're applying for a loan from. they're going to want to see a copy of a business plan, particularly if your business is new or looking to grow. They're also going to want to see a business debt schedule listing any existing debt on the business. Also, they're going to want to see any other relevant information associated with this request. For instance, if the loan is going to be used to purchase a building that may have some tenants in it already, then the client is going to need to supply the bank with a copy of the signed purchase agreement for that building, as well as copies of the leases for the tenants, or at least a rent roll that lists all of the tenants and all of the pertinent details that you will find in a lease, such as the terms and the monthly rent amount. If a client is organized with the proper basic financial information readily available, it helps create a good first impression to a lender. Now, I mentioned before that the lender is going to want to see the business financial statements. I would imagine that for many business owners listening to this webinar, the financial statements that they have will be in the form of business tax returns. Now, there are more preferable reporting documents prepared by CPAs, such as audited financial statements, reviewed financial statements, and even compiled statements. Now, these type of financial statements cost more, but tend to provide more detailed information than tax returns. So given the limited detail that's provided in tax returns, business owners need to be prepared for loan officers to ask for additional financial information. For instance, I mentioned that if applicable, the owner should be able to provide a list of existing debt. Now, CPA prepared financial reporting will have notes included in that documentation that's going to list all of the relevant information that a banker is going to need. So I mention this because I find that sometimes small business owners feel that banks are being intrusive when they ask for more detail, but asking questions is a normal course of the way that underwriters operate when they're underwriting business loans. Now imagine if this is not your first time attending a seminar on applying for a bank loan, that previous seminars you've attended primarily advise you to remember the 5 C's of credit. Now, as a refresher, these 5 C's are character, which refers to the trustworthiness of a borrower or a guarantor; capacity, which refers to the borrower's capacity to repay the loan; capital, which considers the cash or the equity that the borrower has to inject in the business; collateral, which examines just that, the collateral that'll secure the loan; and conditions, which considers the borrower in the context of its industry and the current economic conditions. Now, while this approach isn't wrong, it doesn't go far enough to helping you understand how memorizing these terms will help you prepare for your business loan request. So instead, I recommend considering the types of questions that a banker asks to evaluate these concepts. I like to remind clients to think of those question prompts that we all learned in elementary school: who, what, when, where, why, and how. These are the prompts that lenders use to examine the business loan request. So we'll spend a few minutes taking a look at some of the specific questions that lenders ask themselves and examine where they're going to look to find the answers to those questions. For example, let's start with the question of who. When a lender gets a loan request, one of the first things they want to know is, who is the borrower? And one of the first places that a lender is going to go to answer that question is the business owner's business plan. So it is important when you're completing a business plan that you do it with the reader, in this case, the lender, in mind. This means when describing who the borrower is or who the guarantor is, this should be more than just superficial information. The lender wants the full story as it relates to how the business origin started and how it got from where it started to where it is now. Another place that the lender is going to go to find out who the borrower is the borrower's own website. A robust website leaves a good first impression on the lender, and rightly or wrongly serves as sort of a proxy as to how professional that company is. The lender can also answer this question by looking at the financial statements, because the financial statements will tell the lender if the business is a relatively large company or relatively small company, or if the guarantor has personal financial wherewithal, or if they lack personal liquidity. Lastly, I just want to point out that the banker will also use third-party reports to answer this question to learn more about who the borrower is and who the guarantor is. For example, a credit report is going to tell the lender how the guarantor handles his or her personal finances. Also, a company like LexisNexis or CheckSystems is going to tell the banker if there are any bankruptcies or criminal records associated with the business or the guarantors, or if they owe any money to any other banks. Another who question that the banker is going to want to address is, who does the company sell to, or who do they buy from, or who are their competitors? So be sure that you're able to answer these questions in detail. Another question prompt is what? An important what question is, what is the loan request? What will the funds be used for? What is the collateral? Again, a business plan is going to provide some of the answers, but then there's the other supporting documents that you're going to supply that's going to help with these relevant questions. For instance, if there's going to be a purchase asset, like a building or equipment or a vehicle, which, as we discussed, is going to serve as collateral for that loan, then it's not just enough to write in the business plan the cost and the description of these items. Yes, it's good to include that information in the business plan, but you also need to provide the supporting documentation associated with that transaction, like an invoice or purchase agreement. In addition to providing specificity to a transaction, it shows that you're serious and that the request is not just a pie in the sky request. Now, while I'm on this topic of collateral again, the other important thing that borrowers misunderstand is that banks typically don't lend 100% of the cost of the asset that you're looking to purchase. While that proportion varies based upon the bank and the asset being purchased, clients should be prepared to come up with 20 to 30% of the cost of that asset as equity in their purchase. Now, separately, a major what question is, what are the risks? This is a continuous question that the lender is going to ask herself as she examines every aspect of the loan package. And it is prudent for the client to know what the risks of their business are and how those risks are mitigated. Just to give an example, suppose you're looking to start a restaurant. Well, other than the usual risks that go into starting a restaurant, there's this new risk of a potential government shutdown in response to a pandemic. So it will be prudent for you to know that this is a perceived risk and be able to articulate how you're going to mitigate this risk, say by demonstrating that there's ample space for you to provide outdoor dining or something else. Other questions include when questions. For instance, when are the funds needed? A banker is going to want to know if the business is in a crunch or if they have provided sufficient time to allow for the transaction to take place. Business owners tend to have an unrealistic time frame when it comes to closing on bank loans, particularly when it involves real estate. As I mentioned before, banks vary and some have quicker turnaround times than others, but at minimum, borrowers are going to think about getting a bank loan at least a month out from when they submit, actually before when they need it. But typically, that time frame is even longer, say 2 or 3 months, especially when real estate is involved. When it comes to the question of when will the loan be repaid, this considers whether this is a short-term loan request for instance, a year or so, or if it's a long-term request. Weird questions consider questions like, where's the borrower located? Or where are their customers located? Some banks only lend to customers within their footprint. So your cousin may have received a great loan and a great rate from their local community bank in Atlanta, but you may not have access to that same loan if your headquarters is here in New Jersey. The lender is also going to pull up the location on Google Maps just to see that that business actually exists. The regulators have placed a huge emphasis on the need for banks to know who their borrowers are. So there's more due diligence required in making sure the bank knows everything about the borrower, including what their operations look like. Why questions include, why does the borrower need the money? There needs to be specificity to a loan request. If you're looking to refinance existing debt, for example, you're going to have to provide recent statements to show the current balances of your existing loans, or provide payoff statements from other banks. A common refrain from business owners is that they need a line of credit for working capital. While this is a legitimate need for many businesses, many banks actually decline working capital loan requests if the loan is really paying for an expense like a person's salary, or if there's no collateral. Another why question that bankers ask is, why this bank? They want to know if the business already has a deposit relationship with them, or if they're just shopping around. As I mentioned earlier, if the request is coming from a company outside of the bank's footprint, they may not lend to that company. Finally, we come to the how questions, like, how is the company doing financially? And the most important question of all to me, how will the loan be repaid? The answer to this question will primarily come from the analysis of the business financial statements. In other words, the business tax returns or other reporting statements. When a bank lends money, that loan becomes the bank's asset, and the bank relies on interest from that asset as revenue. On top of that, there are a host of regulatory requirements that banks have to adhere to prove that they're making sound decisions when making these loans, and that the borrowers demonstrate the ability to repay that loan. So this question of how the loan will be repaid is an area that I see many business owners struggle with. So we're going to spend a little time here unpacking this question. So it's very beneficial for you as a borrower to know how a banker determines the client's ability to repay a loan, so that you're not going in blind when you're requesting a loan. The banker's analysis of how the loan will be repaid first starts with the question of, how is the company doing financially? A banker wants to see that the business revenues for the last 3 years have been increasing. A favorable situation is to have 3 years of increasing revenue. Now, they're also going to key in on your profit margins. If you're selling a product, the banker is going to want to see that your gross profit margin is consistent or increasing. This lets the banker know that you have a control on your product costs. The reality is that even if your revenues decline slightly, but your gross profit margin increases, that looks more favorable to a banker because it shows that you're increasing efficiency in your business. The ultimate profit margin of importance is your net profit margin. Again, a banker is going to look for increasing profits here. They're going to look at how you're operating, they're going to look at your operating expenses and how they impact your bottom line. They're going to want to see what your largest expenses are and how you control them. And they're going to want to see that you maintain a profitable company. Now, these are the income statement items that they're going to key in, which ultimately impact some balance sheet items that the bank looks at when determining how your company is doing, which is a function of how much debt you have relative to the equity in your business and your liquidity, which is a level of cash or assets that can be converted to cash or easily converted to cash. These balance sheet items are important, but the banker is going to give more weight to those income statements like revenues and profitability growth to factor the company's ability to repay a loan, because those income statement attributes impact whether or not the business demonstrates sufficient cash flow to service the debt that you're looking for. This brings us to some key ratios that you should be familiar with. Actually, the most important key ratio is the debt service coverage ratio. The debt service coverage ratio serves as a proxy to answer if there's sufficient cash flow and to what degree. So there are two components to this ratio. So let's start with the first part. The first part is what we refer to as EBITDA. which stands for earnings before interest, taxes, depreciation, and amortization. So this ties into your net profit, which we discussed a minute ago. But we're going to add back a few items to this number to get EBITDA. So first is the depreciation and amortization expenses. We're going to add this back because these are actually non-cash expenses that the government allows you to deduct when determining your net income. So the benefit to you is that they assist you in giving you a lower tax base when you're doing your taxes. So the banker adds it back because it's not real cash going out. And in lending, we're concerned with the actual cash that you have on hand to repay your loans. The next item that we're going to look at and add back is the interest expense, because the interest is what you've already paid on previous loans. And this exercise is to see how much cash flow you have to cover interest and principal on all of your loans going forward. Lastly, we're adding back your income tax because this is actually a function of your bottom line after your expenses, including interest expense, and not before. So most bankers allow you to add back income tax when looking at EBITDA, but some bankers are a little bit more conservative. So they look at what they call EBITDA and leave out the T for taxes. And it's just a more conservative way of looking at cash flow from a company. So now that we've covered EBITDA, we can talk about the second part to this debt service coverage ratio equation. Your debt service is essentially your debt payments. So that's going to be determined by the type and the amounts of the loans that you request. So in this example here, we have a 5-year, $25,000 term loan, and it's based on a 4% interest rate with monthly payments of $553, which means annual payments are $6,630 a year. So now we have the two components for this calculation. We can calculate the debt service coverage ratio now. That is the historical cash flow. In other words, the historical EBITDA divided by the payments on all of your debt. Here we come up with a debt service coverage ratio of 1.62 in 2018, leading up to a debt service coverage ratio of 2.10 in 2020. Now, different banks have different requirements for the minimum debt service coverage that they require, but typically, if you have a debt service coverage ratio of 1.25, then that's typically good. So let's take a moment to consider what the banker is looking at, because I forgot another disclaimer. I actually read minds, and I can hear some of you saying that you're looking to get a loan now at this point in time for payments that you're making in the future, and the bank is going to look to see what you've done in the past to see if that was sufficient to cover these future payments. Yes, that's exactly the case. So even when you provide projections, in most cases, the banker is not giving too much weight on your projections because no one provides projections that don't work. The banker is going to give more work to see if your past cash flow was sufficient to cover your current and future debt. This is why the process of obtaining a bank loan begins well before you actually need the loan. By this, I mean that it begins in your planning stages as you're considering where you want to be with your company in the next 2, 3, or 5 years. I also want to point out here that I often encounter sometimes businesses that, how should I put this, report lower revenues than actually earn or add additional expenses to their business than necessary in an attempt to manage their bottom line and reduce their tax liability. Well, these businesses often run into problems when they seek a loan from a bank because they try to convince a banker that they should qualify for a larger loan than what the banker is recommending. Unfortunately for them, a banker has to rely on what is actually reported. So in a nutshell, that's what really goes on behind the scenes at a typical bank when an underwriter is reviewing the loan request. A prepared business loan applicant is one who is prepared with the required documentation that we discussed, one who knows what type of questions the banker is going to ask, and has sufficiently provided the information within the documentation that they provided, or is armed with good answers. Also, a good borrower is one who has demonstrated the historical cash flow to cover the proposed debt and has adequate collateral. So the good news is that while banks are generally conservative, and many borrowers, particularly startups, may find that they fall short in some of the areas that we discussed, whether it be the amount of time in business, or if it's available collateral, or if it's less than 1.25 debt service coverage. There are actually a host of other sources that borrowers can resort to if they don't meet all of the requirements of a typical bank. So this is where the SBA loan comes in handy, which incidentally can still come from a bank. And there are also microloans from community development financial institutions, and that's another good story. So with that, I hope I was able to provide you with a good sense of a banker's perspective when they're looking to examine your loan request. And now I'll answer any questions if we have time.
Yeah, we have, thanks, Hassan. That's a lot of information to absorb, a lot of good information to absorb. So a couple of things. We will be sending the slides out, so you'll have a copy of them and you can review them at your leisure. The recording will be on our website at centraljersey.score.org, so you can review it that way. Also, Hassan talked a lot about business plans. Look for a SCORE mentor. We are very adept at helping you prepare a business plan and prepare it for getting a loan about the things that Hassan talked about. So think about that as well. And here we go. We have 3 questions right off the bat. Daniel wants to know, are business lines of credits always variable interest, similar to that of HELOC?
Yes, so typically lines of credits are variable because that you're borrowing at different times, and that interest rate is going to be indexed to something like prime. Generally, it's for borrowers who are small business owners, it's going to be based upon the prime rate. So, you may be able to get a rate if you have a good financials. You may be able to get something at prime rate, but typically a line of credit is going to be prime plus 1%, 2%, 3%, or whatever.
Okay, and that's okay. Brittany, and this is a very, very common question. What happens if you're a startup and you don't have a business financial history?
Yeah, so getting a traditional bank loan for a startup is difficult. And so that's why the SBA comes in handy. But, somebody may be listening to me right now and says, hey, Hassan, I actually do have a startup, and I went to the SBA and I was looking for an SBA 7A loan, and I was declined because my business was a startup. Well, a CDFI, Community Development Financial Institution, those are nonprofit institutions that are organized to help small business owners who are startups. And generally a CDFI will provide it's an SBA loan. A microloan is they'll provide a microloan, which is an SBA loan, but it's geared towards startup businesses. And so you may not have that time and experience, but you can get a smaller loan. And generally, I think they start between $10,000 to $50,000. But I've heard other CDFIs that do even larger microloans. And you know what? I have some advice for some of you entrepreneurs and people who are thinking about starting a business. And I think this is going to be worth the price of admission. And so here's a secret, and don't share this with everyone. But for some people who are looking to start up businesses, maybe starting up a business is not the right way to go. Maybe purchasing a business is the way to go. there are tons of, I gather most people that are on this webinar are in New Jersey, but you could be in any state. And I gather if you just Google business loans for sale in whatever your state is, you'll be surprised at how many businesses are for sale. Typically, from an owner who may be looking to retire and they don't have, family members who want to take over the business and they're just looking to cash out and move to Florida. So in that case, listen to this. We talked about how you need the prior years of financial history in order for a bank to evaluate your loan request. Well, when you're buying a business, that business owner's historical years are going to be what the banker is going to evaluate to see if the business has the ability to repay the debt. So rather than look to start up for, let's say, for instance, a laundromat, let's not start up a laundromat. Let's look to see if there's a business owner selling a laundromat in the area that I'm looking to go into. And that way I can get a SBA 7A loan. And one of the business advantages to going via the SBA 7A route is because I mentioned before how for a traditional loan, you should be prepared to inject 20 to 30% into whatever it is that you're purchasing. If you're purchasing a business through the 7A loan, you may need only as little as 10% or 15%, at max. On top of that, some sellers are so compelled to sell the business and get out of the business that they'll also provide you with financing to support the bank loan financing. So you may get sellers that will be used to support that entire transaction. So in that case, your equity injection may be even less. So I advise you, if you're thinking about starting up a business that's not really an innovative idea, I would consider thinking about buying an existing business to see if that's going to meet your needs, because then you can apply for a larger SBA loan and have a better chance for approval.
Thank you. That's a great idea. And franchises, you could throw franchises into that. There are a lot of franchises, and they don't all have to be McDonald's, multi-million-dollar franchises. There are a lot of smaller franchises out there.
Yeah, no, thank you for that, Jane, because that's absolutely right, because that's another area that SBA specializes in franchising. And the reason why is because, for a startup, you're doing that. You don't have that historical financial information that a bank can rely on. But with franchises, the franchisor has that information because there are plenty of other franchisees around, and they use that information. The SBA and the lender will use that information to extrapolate from the average result of those other businesses to determine how your business is going to do based upon the historical experience that they had for these previous franchisees. So thank you, Jane, because that's an excellent point.
Here we have a question from Eva. How do you calculate the DID service coverage? I'm not quite sure what that is. How do you calculate the
debt service coverage, right? So
the debt service.
Right. So I believe that's what you're asking for, the debt service coverage.
Yeah.
So that's what we talked about. Let's see here. So you calculate the debt service coverage by, first, you break it down in two parts. The first part is the EBITDA, and the EBITDA is going to be determined based upon the your business cash flow. And then they're going to, so you get a net profit. So in this case, if we look at fiscal year 2020, this company, which is a made up company, by the way, I just made these numbers up. The company has a net profit of, let's say, $10,015,000. So they're going to, so the business owner in this case, to determine their EBITDA, they're going to add back interest expense, which in this case, they had none. They're going to add back taxes. In this case was $900,000. and they're going to add back depreciation, and then that's going to bring the 13,915 for their EBITDA. So that's one part. The second part is the annual debt service. So you need a calculator, you need a financial calculator to calculate that, or you can just ask the bank what the monthly and annual expenses are going to be for, whatever that you're looking to do. Particularly if you're preparing before you go to a bank, you want to, there are financial calculators that you can get online to help you with this calculation. But you're going to calculate how much it's going to cost you to for this debt, and you're going to need to know the term of the debt as well as the interest rate. So that's how you get your annual debt service. And so it's just basic math. After that, you take the EBITDA and you divide it by your annual debt service, and that's going to give you your debt service coverage ratio. And typically, if you're 1.25 or above, then you're in a good position. You can be lower, and that's when the SBA is probably a way to go. If you're above 1 but lower than 1.25, I'm sorry, but lower than 1.25, then you can go to an SBA lender and get an SBA loan.
Okay. And then Michelle has one. What about real estate or rental units where you need a small line of credit? Will business plans still be required?
So that's a different area of lending. So I do a small bit of lending to clients who are looking to purchase properties, investment properties. Typically, a line of credit won't be provided. You're going to need to get a fixed loan. And I say typically because there's occasions where if you're looking to build a property and then you're going to have tenants come in after the completion of that property, that's a construction loan. So a construction loan, you get a line of credit that's going to be advanced as that project is completed. And then at the end, that line converts into a permanent loan. Most borrowers, if you're inexperienced in this area, you won't qualify. Bankers will only give such a loan to experienced developers. But if you're looking to just purchase a property that has tenants, you're going to go for a typical commercial mortgage, and you're going to want to provide the bank with a rent roll of all those tenants. You're eventually going to have to provide them with all the leases, but initially a rent roll is sufficient, because that's how they're going to determine whether there's a sufficient cash flow coming from the tenant to repay that debt.
So in that case, you don't necessarily need a business plan.
So right, so what I refer to as a business plan, probably not a full, complete business plan that you would do if you're a commercial borrower looking to borrow a commercial loan, but you do need something. So, it may not have all of the information, but they're still going to want to know who you are. And so a smaller version of a business plan would be sufficient, because really it's just a piece of property is generating income, and you just need to provide that information. So a light business plan would be sufficient.
Okay, we're running short on time. Michael was asking about non-traditional sources of loan, like the state and so forth. I think you touched on that a bit when you talked about the microloans.
Yes. So
from community lenders.
Right.
Any other ideas about non-traditional?
Yeah. So again, we're here in New Jersey. So I think about the NJEDA, which is the New Jersey Economic Development Association. They also provide direct loans for individuals that may not be able to get a traditional bank financing. And the key with the NJEDA is they want to make sure that you're hiring and your business is growing. And at least for this organization, you have to be a New Jersey-based organization. And there's fintech too. So there are places online that you can go to where you don't have to go to a traditional bank to get financing. There are online places like let's say like PayPal. PayPal actually does lending as well. You know, the drawback to some of these fintech companies is you may get a loan and it may come quick, but they're generally expensive. So typically people go to banks because bank is a less expensive form of debt.
Credit unions might be another
Credit
option.
unions, absolutely. Yeah, I kind of could include that all in banks, but yeah, credit unions as well.
And we are doing a webinar next month in June. Someone from the credit union will be here talking about credit unions and the services they offer to small businesses. So you might come back for that one. I think we are running out of time. Hassan, I want to thank you so much for this excellent information. We'll send the slides out. Get yourself a SCORE mentor, and we can help you walk through this process and look for financing. It is a number one topic among small businesses. So we would love to help you with that. So thank you again for attending. And thank you, Hassan. We really appreciate the information.
Thank you, my pleasure. Absolutely.
Have a beautiful day.
Okay, you too. Bye.
Bye-bye.